Other world markets may be showing signs of recovery, but not China. Yesterday, the Shanghai Composite Index fell nearly 7%, and it's down 23% from the beginning of August. There are now growing concerns that China's falling stock prices may derail its own recovery, with obvious implications for us and for the rest of the world. Hugh Mackay is a senior international economist with Westpac. He says there are a number of reasons for yesterday's falls.
Well, it's really the confluence of a number of events and rumours and hearsay over a number of weeks which are actually weighing on the Chinese equity markets. There's a lot of talk that the Chinese authorities might be tightening policy, slowing down loan growth, and any number of measures which would actually weigh upon the equity market. And all of those events really came together, intersected, if you like, yesterday and gave us that very large 6% fall.
They say that historically China is a volatile market. But what are these current falls going to do to confidence in the region?
Well, that's a very important point, and I think that it will be the impact upon confidence, and confidence is very fragile still, which will really be at the forefront of the authorities' minds as they see how they might want to respond to this movement in the market. I think it's quite likely that they will do something concrete on the policy front, not only to say that the rumours are false about tightening. I think they might do something which actually makes it cheaper and easier to transact in the equity market. Something along the lowering of stamp duties, which historically has shown that it has a very elastic effect on equity pricing.
Is there a sense that China is out of sync with the rest of the world and that on the face of it, it seems to be having its own little credit crunch at the moment?
Well, credit crunch might be overdoing things a little. China actually expanded monetary growth by 50% of GDP in the first half of the year. Now, that is unbelievably large. What is actually happening is the authorities are saying, right, we've thrown all this money into the economy. We know not all of that money is being used productively. And what they're doing is they're scanning the whole landscape, trying to work out where the little bubbles are, and they're going to try and stop those. What they're not going to do is change the overall stance of policy, which is totally consistent with easy money. Why is that? Well, there are still unemployed inside China. Factory utilisation is still very low. And the big one, inflation is actually falling.
Hugh Mackay, thank you.
My pleasure.